So my contribution aims to discuss with you the changes that the current digitalization of insurance is bringing, in particular for consumers. And I come from Europe, so most of my attention will be on the European market, but I'm very interested in knowing to what extent this consideration might apply to other regions. And the reason why I'm asking myself whether or not digitalization is making users of insurance, consumers, better off, is that for sure digitalization is changing completely the insurance value chain. What you have here is a table from EIOPA, which is the European Supervisory Authority of the insurance market, highlighting all the sectors in which are impacted by digitalization. And this trend is creating many benefits for people, is making insurance payout more faster, is making them more uniform, is making them more precise, because insurance companies are now able to calculate and predict maybe even the behavior of customers to an extent that was unbelievable before. But at the same time, these trends are creating certain trajectories that are a little bit more worrying. And these trajectories are particularly evident in common jurisdiction. I don't know if Hong Kong is one of them, because the data I have are from Australia, UK, and US, whereby certain companies, in particularly newly established companies, so not the old incumbent one, are claiming that they are able to provide forms of behavioral insurance whereby the insureds are tracked and followed real time 24/7, and on the basis of their behavior, then the insurance price changes. And for instance, in Australia, there are certain supermarkets that partner with insurance companies, so they know what you are buying, and therefore they know what you're eating, and therefore they know, or they claim to know, how your eating affects your chances to have certain illnesses or to die before or after. Or they partner as well with gyms in order to check whether or not you are training, or by simply with the data you have on your smartwatch, saying, oh, you completed thousands of stairs today, or zero. Now, all of that, which we might call behavioral insurance, is tricky, because it's clearly also a way, it's what in Shoshana Zuboff calls surveillance capitalism, meaning you have a company that is really following you all the time, providing a lot of benefits, but there are also certain risks involved. And since I deal with insurance from the consumer's perspective, which I understand is a very strange perspective to deal with insurance, but I tend to be a little bit more concerned with the risks than with the benefit. So in terms of risks, there are some that I would like to highlight here. As I already mentioned, it has been noted that the ability of insurer to monitor people 24/7 is giving rise to a form of techno surveillance, and therefore is giving rise to an increased ability of insurance company to do the so-called hyper nudging, meaning finding the right way to tell people to do the right thing. Of course, what insurance companies think is the right thing, which may be, for instance, eating better, which we might all agree about. But what is the limit? I mean, to what extent are we happy that insurance companies is pushing us to eat more salad rather than go out for a drink? And I don't have the answer, but I mean, it's a blurred line, the one between the good nudge and the paternalistic one that is really limiting autonomy and behavior. And what you have there is just some literature about the fact that yes, human beings tend actually to react to nudges a lot and tend to react to quantified nudges even more. So whenever you see that the increase of the price is really something that makes people change their behavior, even if they might disagree with their rational underlying. Other problem is that this way of keeping track of people's behavior and gently suggesting changes is a very delicate process. So depending on how it is realized, and it is pretty unclear to what extent insurance companies are actually able to fine tune it. it might lead to certain unintended effects. Just to make an example, I'm a woman, I'm already under a lot of pressure to be thin. If I also have my insurance companies telling me, don't eat fat, then I might develop an eating disorder at a certain point because, the pressure simply becomes too high, which is an example of a bad nudge, meaning a nudge that actually create the wrong stimulus or exceeds in the stimulus. Or the same thing about gym, it's good to exercise, but also the more you exercise, the more exposed to injury you are. So it might be that the behavior that is supposed to be good actually leads you to something that is bad. And moreover, going still on the nudges, you are a human being, we react to nudges, and we are also smart. So when people understand how the nudge works, there is always a fraction of people who understand how to bypass it. I mean, how to manipulate the nudge to their own benefit. Like, okay, I'm tracked for what I eat, so I pay with a credit card all the salad, and then I buy alcohol cash. So my insurance company thinks I'm eating, what I'm supposed to, but then actually I'm doing something else. And I was talking with an Australian friend recently, and she told me that about this gym issue, the insurance that knows whether or not you go to the gym, that a friend of hers, she understood that you can simply go to the gym, pass the card. The insurance companies think you are at the gym, but actually you aren't. And then the prime decrease, which is exactly an example of the fact that they probably need to fine tune it better and to find ways to discover what's really happening. Moreover, another problem is a more general problem related to what you see in the slide mentioned as anchoring effect of self-fulfilling prophecies. So there is the risk that the more we use this kind of allegedly predictive technologies, which are allegedly predictive but actually are mostly based on past data. So they try to infer the future from actually what happened in the past. There is the risk that certain divides that already exist in society, such as racial divide or gender divide or economic divide, are kind of projected, and instead of being kind of diminished, they are actually further entrenched in the system. And here, probably the best examples comes from health insurance and the self-tracking behavior. Now, when we have insurance related to people who self-track what they do and who connect, the blood pressure and all of the data of insurance, it might be that the people subscribing that are people who are ill and who actually need to be tracked for medical reasons. But a lot of the people who are happy to do that are mostly, young people who don't care about privacy and who do not properly understand what they are doing. Now, these people are probably people who are good at, and people who train, and people who believe that this system is beneficial to them because actually they fit in the category of a good consumer. And so these people are feeding the repositories of the data of insurance companies. And these people, as arguably, they are largely, as we said, young and healthy. But all these data at some point will create, the standard for the good and healthy insurance customer. And the standard will automatically mean that whoever doesn't fit the standard will be somehow put at the margin by being obliged to pay a higher price. So this is what people have in mind when they speak about the potential exclusionary effect of this kind of technologies, that if not controlled or somehow compensated, they might lead to the financial exclusions of all of those that do not fit the standard paradigm. And well, then there are those who are particularly pessimistic, who said this kind of insurance is actually not even insurance as we used to know it, because insurance as we used to know it was supposed to be based on solidarity and uncertainty. Now, if insurance companies know everything, which of course is not the case, but let's imagine that they might, the day they will know everything about us, there will be no uncertainty and no solidarity anymore, because it will be just a bet about us and not anymore a pool of people equally exposed to certain risks. And then there is another problem, which is related to another feature that is very well known of emerging technology, which is the ability of technologies to either find out causal relationship between certain factors and certain outcomes where we don't want these factors to be considered. Once again, gender is a good example. In certain fields, we don't want gender or race, to make another very well-known example, to be a criterion. I mean, it could be, because actually statistically it would make sense, but we don't want for policy reasons. And yet, the problem is that emerging technologies are able, no matter whether you take out all the data about these factors, no matter whether you tell the model not to take care of that factor, they take it back in. And it's, the computer scientists are trying to find a way to solve that, but till now, as much as I know, they didn't. That's one problem. The correlated but different problem is the ability of these kind of technologies to draw the so-called spurious correlations. So to draw correlation between things that actually are not causally, every time I make confusion between the two, connected to one another. I give you immediately an example. Insurance companies know that people who own orange cars are less accident prone than the others, but they don't know why. There's no idea. Maybe the people who like orange cars are, old, and therefore they drive slower. I don't know. There should be something, but they don't know the reason. Now the question is, would it be okay for the insurance companies to use this data point, which is one of the many variables that emerging technologies can find out as relevant, as a criterion for determining the price? It's very debatable, because the traditional variable have been defined by actuaries in 2 centuries or more of their science, while these criteria are have a very uncertain basis. And last problem is the fact that it's a general problem related to digitalization in general. Digitalized insurance is actually makes it harder for consumers to understand what's happening, and therefore also harder for them to react to anything that is going wrong. This is because most of the times, you might interact with your insurance through screen and receive a personalized treatment that applies to you only. Therefore, you don't even have a term of comparison. I mean, it's not that you can see, oh, he got something better than me, because what he got is completely different from what I got. And if we don't, typically we perceive injury when we are able to understand that what happens to us is different from what happens to somebody else. And we also have to consider that the variables that are taken into account for this insurance are so many and so opaque and so much not connected to what people perceive as belonging to their own identity, such as the color of my car, or the version of the browser from which I connect myself to the insurance website, that is very hard for people to perceive that they belong to a category that is being mistreated because of that factor, that people don't even know it's a relevant factor. So all of that to say, digitalized, connected, 24/7 insurance is wonderful, but it has certain risks. In particular, this organization, which is the one I already mentioned, the EIOPA, the European Supervisory Association, it highlighted in the report you see there of 2021, a report about the impact of artificial intelligence on insurance in general, that this kind of development is going to create particularly risk for the so-called vulnerable consumers. So in particular, those who already belong to fragile categories are more at risk, and more at risk than anybody else are those who are in situations of so-called intersectional vulnerability, meaning people who combine different reasons. Let's imagine a diabetic 75-year-old woman, something. So this kind of vulnerability is not simply the sum of the different reasons of vulnerability, it's worse. It's like a combined effect. And they warning to do something about that. Now, as I said, I come from Europe, so I can only talk about European law, because much of this probably might be true independently from the national borders, but I would like to provide you an idea of what European law, in particular concerning consumers, because the real insurance expert here is Paolo, and he will deal with the insurance side. But in particular concerning the regulation for consumers, what Europe did. And Europe did quite many things, actually. We are probably one of the places where consumers are overall better off in the world, so that's something to be said. I still think it's not enough, but nobody is perfect. So what you see here is that the European Union enacted legislation about business to consumer contracts, essentially obliging enterprises to to not use unfair terms inside their contracts and to put only clear and transparent terms and conditions. They enacted a quite strong and famous regulation on data protection that prohibits treatment of data if there is not a legal basis, and the most famous legal basis is consent. They enacted obligation for digital intermediaries requiring online platforms to have understandable and intelligible websites and quite transparent recommender systems. And they enacted very recently, they enacted even a regulation on artificial intelligence, which considers certain uses of AI insurance only for the determining the price in health and life insurance.
Underwriting and pricing.
Underwriting and pricing in health and life insurance is considered a high risk use of AI that therefore obliges insurance company to do many things that are expensive for them to do. So we have the regulation. I mean, we have rules that somehow try to protect the consumers. However, the problem is enforcement. I mean, we have the nice rules, but as usual, one thing is the paper, another thing is what happens in the real world, in the daily life. And much of these layers of regulation rely on the so-called public enforcement, meaning on the fact that there will be supervisory authorities checking what's going on and preventing or sanctioning, which is of course good, but our supervisory authorities are not that very well funded. I mean, they have limited capabilities, so they cannot go after all the things that are happening on the market. To answer to the dark spot, I mean, to partially compensate this failure of supervisory authorities to publicly enforce these rules, there is also the so-called private enforcement, meaning that consumers can also react, can bring their complaints, and can enforce their rights through litigation. But here we are back to the problems that consumers, most of the times, they don't do that. They don't do that because often the kind of harm they suffer is really minimal in economic terms. I mean, it's huge, might be huge profit for the company, but it's minimal in terms of the individual consumer concern. Or simply, it might be because they don't even realize they suffer something wrong, because maybe it's hard many times. For instance, a data breach. How do I know that my data has been breached? I mean, I really, it's really very hard for me to get that knowledge. Or it might be that they don't have the time, the energy, the money, and the resources to go after. So private enforcement from the perspective of consumer is not really a very viable option. That being said, I recognize that, as I said, at least we have the law on paper, which is better than nothing. I'm sure that Pierpaolo will give you a much more optimistic overview of the state of insurance market in Europe, but I think my time is over, so I now hand the microphone to Pierpaolo.
So, good evening, everyone. It's a pleasure to be here with you in Hong Kong, a city that stands at the intersection of innovation and financial leadership, and at the University of Hong Kong, which is a very well-known legal excellence center worldwide. So my approach will be different from the one of Marta. Marta focused on vulnerability from a consumer perspective, while mine will be more related to the insurance sector without any specific reference to consumer. And of course, as she already mentioned, our experience will be mainly based on the EU law. However, I will try to explain how this experience can have I cannot say an impact, but can be helpful to other jurisdictions, and above all, in dynamic regions like, let's say, the Asia-Pacific area, because we will see that the impact of vulnerability is borderless. So, first, let me begin with let's say, simple yet far-reaching premise. Digital vulnerability goes beyond cyber threats. it reaches the deep into the very foundations of a trust, resilience, and fairness into our insurance system. But why insurance? That's the first question. Why? Because insurance is not merely a product or service. Insurance is a social and legal infrastructure. Because insurance enables individuals and businesses to take risks, to innovate, to invest, and plays a pivotal role in recovery when things go wrong. In a digital world, insurance is also exposed to entirely new vectors of fragility, ones that are not only technical, but also organizational, ethical, and regulatory. That's the perspective, my perspective now, in the following slides to explain, the exposure of insurance, but I would say of the society, to digital vulnerability. So, insurance, as I mentioned before, is the backbone of our risk-based economies. But this backbone is increasingly digital. Today, the insurance industry depends on algorithms to underwrite, cloud infrastructure to restore data, and platforms to distribute insurance products and services. This creates immense efficiency, however, also deep systemic risks. A failure in one part of the insurance system, such as pricing algorithm producing discriminatory results, as Marta mentioned before, can ripple across the economy, undermining trust in the entire financial sector. That's the reason why digital vulnerability is not a marginal issue or something which is technical, but is central to the legitimacy and stability of the insurance market, and through the insurance market of insurance of business and society in the 21st century. So, but where does a digital vulnerability come from? So I think that we can identify three primary sources. First, technological interdependence, because of our reliance, the reliance of the insurance sector on digital supply chains and external providers. Then the algorithmic opacity, because of the use of AI models that we cannot fully explain or control. And finally, the governance gaps, which means the difficulty of embedding digital risk into traditional legal and regulatory frameworks. Once again, these, as I mentioned before, these are not mere technological issues. They are essentially, basically, governance problems. They require legal systems to adapt, rethink, and innovate. So let me begin, to explain this kind of these sources. First, technological interdependence. So insurance companies, most of the insurance companies, are no longer self-contained. They are part of a global digital supply chains, relying on cloud providers like AWS, third-party claims processors, or embedded insurance services offered through e-commerce platforms. This means that a technical failure, such as a cloud server clash, could simultaneously disrupt claims processing across multiple jurisdictions. In legal terms, this raises issues of outsourcing oversight, data sovereignty, and cross-border accountability. a problem which seems to be local because of the interconnections can be global in the insurance market. Then the second vulnerability comes from the algorithm opacity. AI and machine learning are now essential to modern insurance. However, the law is struggling to keep pace with how the systems operate. Underwriting and pricing models are increasingly based on self-learning systems. This can introduce bias, exclude vulnerable groups, or produce decisions that no human and no court can properly audit. An instructive real-world example, although outside the insurance domain, illustrates these challenges clearly. This happened in the Netherlands a few years ago. The tax authority used an AI system to detect fraud in childcare benefit claims. However, the algorithm unfairly targeted families with dual nationality, mistakenly identifying many innocent individuals as suspects. At the end, thousands of them were forced to repay benefits they had legitimately received, resulting in severe financial hardship. The scandal was so severe that it resulted in a resignation of the entire Dutch government in 2021. But why this case is relevant? First, it involved AI-driven black box decision making. Second, it amplified the bias embedded in training data or selection criteria. Third, there was an insufficient transparency or human oversight. So, from a legal standpoint, this raises challenges to the principle of transparency, explainability, and non-discrimination. So, the third axis is governance. So many insurers, they are still treat digital risk as a technical or IT issue. It is not. We need at the insurance level boards. At the insurance level, we need a board level digital expertise. We need integrated risk management and cross-functional governance structures that include legal, ethical, and operational dimensions. If I look at most, I don't want to say all the insurance undertakings, there is a siloed approach where compliance, IT, and strategy speak different languages. This is a structural weakness. And now, based on that, what was the reaction of the European Union? So, in the European Union, these challenges, which I have briefly summarized, sparked a regulatory transformation. Three landmark legislative initiatives stand out. DORA, which means Digital Operational Resilience Act, addresses systemic risk from technological interdependence. Then, as already mentioned, the AI Act, which focuses on fairness and transparency in high-risk AI systems. And third, the review of Solvency II, which is, the main pillar of the insurance regulation in the European Union, which now embeds risk, digital risk, into prudential governance. These reforms are not superficial. They are expected, let's say. They should change how the insurance sector is supervised, how insurance undertakings must operate, and how citizens are protected in the digital age. Let me be more specific in order to give you, let's say, the main takeaway of my illustration. So, DORA creates mandatory standards for information communication technology resilience and third-party risk management. The Artificial Intelligence Act imposes obligations on insurers to ensure the explainability and fairness of their algorithms. Then let me add to the previous list the second Network and Information Security Directive, which enhances cybersecurity across critical sectors, including the insurance sector. And the last but not least, Solvency II, the European Prudential Rulebook, which now requires digital risk to be formally integrated into the own risk and solvency assessment, commonly known as ORSA. So together, this regulatory approach gives us a result. And the result, in my opinion, is a shift. And it's a shift from a culture of compliance focused on ticking boxes to a culture of strategic resilience, where digital risk is embedded in the firm's long-term vision, governance, and decision-making processes. This is, what is arising from this, several reforms or new acts that we have. We need to be aware that digital vulnerability is something that we don't have to manage. We need to govern. That's the challenge to the insurance industry arising from the digital vulnerability and, or better, the digital exposure, and what is requested from these mainly three legislative acts. We need, as insurers, as insurance industry, to govern these risks. And why does it matter globally? I try to answer now the question why you are discussing something related to the European Union in Hong Kong. I think the answer is threefold. First, digital risks are borderless. So, which means that a data breach in Frankfurt can affect consumers in Kowloon or vice versa. Second, Hong Kong is one of the global hubs in the world. So, which because it combines, financial innovation and legal sophistication. So, which means that I think that these issues are here in Hong Kong too. And third, the European Union offers principles rather than prescriptions. This is very important. European Union in the previous regulations I mentioned emphasize proportionality, accountability, and cooperation, which are values that can be adapted to local priorities rather than imposed. So, my final reflection is that first, digital fragility, digital vulnerability is not a weakness to hide, but is a structural reality that requires a shift from reactive compliance, ticking boxes, to proactive strategic resilience. The real challenge, as I mentioned, is not to manage risk. The real challenge is to govern the risk through informed, adaptable, and forward-thinking institutions. This is what the regulations mentioned before are requesting to the insurance sector, to be resilient. And the EU is developing an approach which is, first of all, far to be perfect. I want to be clear on this point. However, the approach of the EU is trying to combine, as I mentioned, adaptable flexibility, because EU issued harmonized rules applying to all the EU member states, but leaves some room to each member state to adapt this digital vulnerability to the size of the market, to the culture of the specific market. Then the proportionality, because all insurers are exposed to the digital vulnerability, but you understand that a multinational cross-border operating insurer is exposed in a different way compared to a small insurer concentrated on a specific area. And the proportionality means that we will adapt these rules based on the nature size of the risk of the supervised entities. And then I would say the cross-border relevance, because digital infrastructures do not stop at the national border. For instance, in Europe, we do not have a cloud provider. All our data are based abroad. You can imagine this, the impact. The Artificial Intelligence Act is mainly focused to give us, let's say, a defense from AI developers, which are mainly based outside the European Union. And then we want to be sure that the algorithm is programmed in a way which is complying with the human rights that the European Union selected and want to be observed, regardless of where you have developed the tool. It's important that a tool used in Europe needs to comply with these rules. Then, outside Europe is not a matter of Europe. So, at the end, I think that the message is that the insurance sector is dealing with the digital vulnerability, because, as Marta mentioned, digital vulnerability can affect customers, and of course, insurance sector should take care of customers, but digital vulnerability is affecting insurance as an industry, because, as I mentioned before, insurance is an industry based on trust. When you sign an insurance contract, for sure you pay a premium, but you receive a promise. And then you have to trust to the company who promised you to pay something in the case of the event, if and when. So, which means that digital vulnerability can have a positive impact, but can also have a negative impact to the insurance industry. That's the reason why regulators in the European Union are requesting insurance industry to govern rather than merely manage the risks arising from the digital vulnerability, which I tried to summarize previously in the three main areas. Thank you for your attention.
Thank you, Paula and Marta. That's very timely and thought-provoking presentation. We will now move into the discussion after the commentators' remarks, and we'll open the floor to the audience.
Thank you, Paula, for the very presentation. I learned a lot, and I made some notes. I also have some questions and open remarks. So first of all, I think using AI, or for example, digital technologies in the insurance sector, there's a tension, because always say in the insurance sector, we are using technologies actually to address, let's say, very important information asymmetry between the insurance companies and their customers. And let's say we call it adverse selection and moral hazards. So basically, I agree, for example, Paul and Martha, using AI in this area is very promising because to some extent it shows a lot of potential to, let's say, for the regulatory perspective, right? So if it used in a correct way, then it actually can reduce this selection and more hazards, and then to some extent it can achieve some regulatory objectives. But then I agree on the other side, if it is used in a way that is not properly regulated, then there's a kind of attention to the other party, let's say the consumers, right? So this is to some extent I summarize and learn from your presentations. And then I find a very interesting point that to some extent mentioned, both of you mentioned, I think even if that is not clearly addressed by your presentation, that is data. Martha mentioned actually we use this AI and we make a lot of inferences, even if let's say consumers have no idea how it works. And here I remember there are also some other cases, for example, the data is very complex because to some extent not show the identity of one person. Sometimes I remember relational data, right? So for example, if I know your parents, I also know yourself. So that is to some extent okay. If your parents consent your, let's say, process your, for example, biometric data for insurance companies, then directly they will also know you, not only your parents, right? So this is something very difficult. And also in the online context, for example, we have this footprint, right? So they collect our data in different, but then how they design this interface. So we make a lot of let's say uninformed consent, even if, as Martha said, we don't know how it works. Let's say these dark patterns, hyper nudging issues, right? So to some extent, the consumers actually the lack of such knowledge whenever they are dealing with this AI or new technologies. So in that case, data, I would say, is something kind of lotus, even if, let's say, it is not directly addressed either by the insurance regulation or, let's say, AI regulation. So this is something I find a very challenging issue. Another issue is, I think, it also relates why we have, let's say, this presentation held by this law center here. That is, of course, this all this insurance regulation and AI Act, for example, in the EU, they also have some effects, let's say, to the extraterritorial party, especially this AI Act, because if you read this article and this any deployers and providers, even if they, let's say, have their establishment outside the EU, but their, let's say, activities using AI having influence on EU citizens, then it will also be covered by the EU AI. So to some extent, obviously, for example, the insurance companies or AI developers based in Hong Kong or mainland China, wherever it is, it will to some extent be, let's say, be covered by this AI Act. So this is one issue that I also learned. Also, one interesting issue is not directly covered by Pier Paolo. This is a legal issue. For example, the deployers, or for example, insurance companies, they actually subject, especially this high-risk AI system, subject to some obligations. And one of them very interesting is Article 26 of the AI Act about this fundamental rights impact assessment. Actually, I have some problem with this because it's very, very general and we don't know how to implement it actually in the following years, but obviously it applies to not to all deployers of high-risk AI system, but for sure, as it mentioned there, it applies to insurance companies. So we don't know, we cannot evaluate, let's say, the influence, exact influence at the moment, but later, I'll say, we need to take this issue into account. Last but not the least, when I was listening to your presentation, I was actually thinking about let's say the general issue, why and how much do we need this regulation of AI in insurance sector? Because I think we still lack a lot of evidence for that, right? So either in Europe or in China, in Hong Kong, I think now we are talking about too many questions or too many issues, thinking like that, okay, whether we over-regulate or under-regulate it. But the problem is, let's say, okay, how, in which cases, right, for which purposes it's actually used in the industry, and how many people are influenced by it, in which content. So I think later maybe we really need some evidence about it. And actually, this is also my last remark, is from my understanding, I don't think this AI Act generates a very big impact on insurance sector. On the other side, I think I don't comment on other applications. I mean, because people have other comments on other applications. But for insurance sector, I would say influence would be very low. So, for example, Paulo also Marta mentioned a very direct application would be this high-risk AI system, defined as high-risk AI system, which is specific to the insurance that is using AI to categorize and price health and life and health insurance. Right? If I remember correctly. Then that is very small and specific things, which means a lot of the type of insurance, for example, liability insurance, property insurance, or other types of insurance are not included. So very small portion. And secondly, I would say maybe we can talk about, let's say, biometric based system. For example, biometric categorization that will be very small of them will be considered as prohibited, but others will be considered high risk. But then let's say, okay, whether how many, in which cases, again, this is evidence-based research, right? In which cases we use biometric data to categorize people in insurance? That is not a question. And if so, can we reach out the same effect without using biometric data, right? So this is I would say this is a practical issue. And then I was thinking, for example, this remote biometric identification, which to some extent will be generally categorized as a high-risk AI system in the AI Act, even if for those certain applications in the, let's say, law enforcement purposes in public available places will be prohibited. But anyway, I don't think it will be generate any influence in the insurance sector because of this definition of remoteness. Because if I remember correctly, in the beginning of this year, which is some EDPS or some authority in Europe, they published an explanation about this prohibited AI system, but then they defined, let's say, the meaning of this remoteness. And they remember that normally, if we, for example, use our cell phone, and then let's say we use our biometric identification, and then do some insurance-related services, it do not fall under the let's say remote biometric application. So they still think you are not physically remote from using this AI system. So basically, you still have understanding how to use that. So in that case, I'll say, okay, that is not influence AI sector at all. Last section, application, and I agree with Marta, and I think this is actually something really need to be taken care in the insurance sector, that dark patterns. So because we are, let's say, insurance, like many other sectors, using a lot of these manipulative interfaces in the, let's say, mobile phone, whatever, website design, and then they to some extent generates these manipulative issues. So I think maybe this is a most challenging and important influence on insurance sectors. But all my comments are from, let's say, the EU AI Act perspective. But it's also, I think, to generate some the open discussion, let's say in Hong Kong or in China, when we are designing this insurance-specific AI applications, what kind of regulation we really need. So that's all my remarks. Thanks.
Do you want to respond?
Uh, yes, so there is a long list. So,
You want to go ahead?
okay, so AI Act and insurance. So the insurance sector said we don't believe AI Act should apply to the insurance sector because almost all the rules are already in place in the insurance sector. This was also the position accepted by the European authority. However, the European Parliament, the European Commission, and the Council said no. Probably more for a political reason. So why do we need to exclude insurance from the first worldwide comprehensive regulation on artificial intelligence? So basically, this is the reason why they decided to include insurance. Then insurance is included. Which one? Because, as I mentioned before, underwriting and pricing, which is different from underwriting or pricing, which means that from a literal point of view, the tool must perform both underwriting, which means selecting, because of pricing. Otherwise, it is not. Second, life and health means all and nothing. Why? Health. We do not have a definition of a health insurance in the European Union. So, which means that, and I would say in almost all the EU member states. So, what is health? We really don't know. The answer will be different from Italy, Germany, and so on. Second, life. Life, if the assumption is underwriting and pricing, okay, it means pure life insurance. Agreed. And if we have insurance-based investment products, which are mainly unit-linked products, we are not underwriting and we are not pricing. You want to invest $1,000, $5,000, $1 million is up to you, right? So we are not asking you for a premium. So which means that if we look at which part of the insurance product will fall into the definition of life and health based on the assumption that the AI tool must be used to underwriting and pricing, you see that there is a restriction. Having said that, first, EIOPA published an opinion on EIOPA is the European Insurance and Occupational Pensions Authority, which is not a supervisory authority, but is, let's say, is trying to strengthen a more convergent interpretation from all the 27 national competent authorities across the 27 EU member states. EIOPA published an opinion under which said, okay, we know that the Artificial Intelligence Act is covering high-risk tools applying for underwriting and pricing, life and health. Then we have low risk. And for low risk, we believe that we need interpretations. So now, interpretations on low risk. And these interpretations on low risk in the idea of the EIOPA are quite close to those arising from the AI Act for high risk. Why? For the reasons I mentioned before. So, insurance sector is already over-regulated. Just to give you an idea, the overarching principle in the insurance sector in the EU is that distributors, which means insurers and intermediaries, must always act honestly, fairly, and professionally in accordance with the best interests of their customers. It means that they have to do this when they are designing the products and when they are distributing the products. So acting in accordance with the best interests is already covers, is unrelated to high risk, low risk. You have a customer, you design something, and that's the reason why you have to comply with these rules. And I think that the impact will be mainly in terms of product oversight and governance, which is the process regulated by the Insurance Distribution Directive, the other pillar of the insurance regulation in EU, which is prescribing a number of steps to the insurance manufacturers when they are designing the products, including the digital products. They have to explain that they have a full understanding of the AI system they employ, and they have to explain, they have to stress test this, and they have to demonstrate to themselves first, and that's the reason why the compliance, because plays a very important role, and then they have to demonstrate to the supervisory authority that they have a full understanding on how the AI tool works. It is not a black box, and they have to demonstrate that they have an understanding of the bias, and they have to act in order to avoid this. This is, the insurance sector. Yes, I agree. The AI Act will be not disruptive. Why? Because the insurance sector has already embedded this. But this is disruptive in terms of change of risk culture. We move to a governance rather than the management.
Thank you. So let's just take
Sure.
questions from audience. So if you have any questions, please raise your hand.
I guess I'd like to hear the speaker's view on the observations made first before I raise other or comment on what I have heard, just in case it's not covering everything.
Yeah. Well, we are asked. Yes, I will be.
Yeah, because I blocked it.
No, it's fine. I will be super brief. Thank you very much for all the comments. Just wanted to pick up some of the things you said. You said we need more data. You're absolutely right. We actually don't know what insurance are doing. I mean, he knows everything, but we don't. But it's true that EIOPA is making some inquiries. And recently, like I think in 2024, I read a report about where is actually AI used in insurance, because we mostly are worried about pricing. I mean, that's what really scares everybody, but that's exactly where it's not that much used.
Fraud detection.
Exactly, fraud detection, cybersecurity, a lot, and then also loss management, which is something strange, but like, for instance, there is a lot of AI going on in detecting immediately to have the AI detect from pictures, for instance, of a damaged car, what is the extent of damage in order to predetermine what the value should be of the loss. So in those sectors, which are not the ones considered by the AI Act, I mean, are different, we have insurance using the AI. So it's really important to understand what's happening. And a very small thing, we are perfectly right also on the fact that the AI Act is bringing, no matter whether it is correct or not, etc., is bringing a lot of uncertainty because it's a monumental piece of legislation. I mean, more than 100 articles, very hard to read, extremely incomprehensible to anybody. I mean, also to Europeans. And I was recently involved in a closed seminar called by insurer ethicists, which I didn't even know they existed. Exactly, I know. That's one. An ethic advisor for insurance companies. That's his job. He lives on that. Anyway, he put together different professors because he was scared by one of the provisions of the AI Act, one of the bans, not the one on facial recognition, which is the one you mentioned, but another one. There is a ban. Ban means really you cannot do that, and that ban is already enforced, differently from the IRIS provisions we are talking about. The bans were immediately enforced. And the ban is the ban about social scoring. So the AI Act says, and I know we don't have time, but it's really also to give you an idea of how ugly written it is. It says that any AI system that is used for the classification of natural persons over a certain period of time based on their social behavior or known inferred or predicted personal or personality characteristic with a social score leading to an unfair treatment is banned. And he was saying, oh my God, that's exactly what insurance companies are doing, because they are collecting data on people and putting them in categories and then deciding certain consequences for them. So does this mean that the insurance market sector is now, closed, which of course it's not the right reading, but we don't know what the right reading is. I mean, we can exclude this, but then what exactly this prohibition means, we are still struggling to understand. So it's problematic, yes, and there is a lot to be done. Sorry, no, I'm back.